And the question of the day, what will actually happen to Netflix shares after hours? The long-awaited earnings report is going to hit after hours today on January 17, 2019, the first Netflix report for the year of 2019. Ton of volume is trading in the options on Netflix today. Crazy. 12,000 contracts at the 300 puts, 12,000 contracts at the 400 calls, and all kinds of thousands of contracts in the middle. So what will happen to Netflix after hours? Simple answer, exactly the opposite of what happened to Netflix last time it reported earnings. And if you haven't been following our channel for some time, exactly 3 months ago, on October 16, 2018, I have posted a video specifying and outlining exactly what Netflix was going to do after the earnings report that day. Let me just take a step back and refresh your memory. This is where Netflix was trading the day before that earnings report. Surprise, surprise, it's actually coincidentally very similar to where it's trading today. Right now it's trading around $3.52 a share going into the earnings. Now, it is 1 p.m. on January 17th, so it could maybe spike a little bit going into earnings at actually $3.58 or $3.57. It could, maybe pull back to $3.50. So, but really close to where it was trading last time. Now, we also posted multiple videos on other Netflix earnings on this channel. So if you're curious specifically, how do we make these predictions? And if you're trying to learn on how you can do the same thing, you can easily just review the videos. I'll give you a lot of insight. Now, we actually made the prediction in July right here, predicting this huge drop right here, which took place. After this one was a little bit more interesting. Let me fast forward now. We were basically, when Netflix announced really great earnings on October, pre-market it was trading significantly higher. We stated that it was going to drop and sell off with great probability, first hitting the 350, then the 330, all the way to 290s within the short amount of time. That's exactly what it did. Now, what we're saying is now, today, it's actually going to do exactly the opposite. So you see how the last earnings report, it actually gapped higher the next day, and it moved higher, and that's when we were shorting it right here. And then the huge drop took place. So what we're believing is this time, it's going to be exactly the opposite of what's taking place last time. And so, since I've got the chart right here pulled up, let's just go through the chart. Clearly, Netflix is up from $230 all the way to $350 in just a matter of a couple of weeks. And so the main argument is this: look, it just has gone too far, too fast. I mean, this magnitude of the move is absolutely insane. So a lot of put options that are being traded on Netflix today basically tell us that a lot of people think that Netflix is going to drop. Now, the chart is extremely bullish. How could it not be? I mean, clearly the stock has just rallied, $120. This is literally insane, right? Why? Because, well, not many people realize, if you studied the Netflix history, it had a stock split 7-to-1 when it hit basically $700. So if there was no stock in Netflix at the current price of $351, it would actually be trading around $2,600, which would be like putting it at the price level like $1,000 higher than Amazon, which, not many people realize that little detail. But it would basically equate, this move in Netflix would literally equate in terms of, without the stock split, it would be like the same thing as Amazon moving, let's say, from, $1,400 all the way to, $2,600 in just a matter of 2 weeks. Now, Amazon literally just moved from $1,300 to like $1,600, $1,700 level. So this move basically is absolutely insane. And you know me, I love to short stocks. I love to look for opportunities like this to take advantage because, clearly we're able to identify it last time. And, these are very lucrative opportunities because, as you can see, once you can identify that trading opportunity, as far as options, it can make you a ton of money because this move is very consecutive and very predictable after that. Now, what we're seeing now, very, very odd things. Generally speaking, when stocks start hitting these levels, right, let's say this 200 moving average on Netflix right here, there's a great probability after a huge run-up like this, it can actually pull back and drop. It already had a chance to do that. And what do we see? Look at these little areas that I placed right here. Not only Netflix shares were consistently moving higher, but they were gapping up high. It's like instead of walking, it was literally sprinting higher. It was like flying higher. Look at these gaps. One gap higher. That's a very bullish move, right? Another gap higher. That's a bullish move. Another gap. And just when it hits the 200-day moving average, and most of the people would say, look, this is a good level to start shorting this thing, because after such a run-up, it can definitely maybe revisit this level right here, the 50-day moving average, let's say 287, which wouldn't be unreasonable considering the huge rise in a short amount of time. But what do we get? We get another gap up higher. Now, the important thing about the last two gaps is this. Look at the volume. Okay, now, if these gaps higher were happening on like insignificant volume, insignificant would be kind of like, you know, see these gray bars right here, or even the volume today. Well, you can't really count the volume today because, you know, this is, again, it's 1 p.m., so you don't have the entire volume bar. So even if it ends up being at this level right here by the end of the day, I mean, it's basically trading today on average volume. And you can understand why it would be trading today on average volume, because not many people want to, you know, be jumping in. We're so close to the earnings, they really want to hear what the earnings are going to be before they would be committing capital. So generally, the volume like that going into earnings is something that happens all the time. You're not going to get the highest ultimate volume going into the day of the earnings. But the main point is this. Look at the volume. So we started with the lows right here on the 24th, and the stock made a substantial progress, but on lower volume initially, and then the volume started picking up, and that's really when it got interesting. Now, it got super interesting because the highest volume bars actually happened recently, and this largest volume bar was on the gap from 334 to this 350 level on the news of the price increase. So if we look at the volume, volume is extremely bullish. Now, generally speaking, when a stock makes such a huge progress in such a short amount of time, you will actually see institutional investors coming in and locking in gains. But we're not seeing them do that right now. They actually keep committing higher amounts of money at these higher levels. Now, just think about it. A lot of times, you know, our trading strategies are very simple. And if you try to make a better decision, at times a very good question to ask is, okay, if I was an institutional investor buying billions of dollars worth of Netflix shares at these high levels where the odds are practically against me, the fact that it's going to move higher, why would I be committing such huge amount of capital as the volume bar right here represents, right? I mean, there was over 20 million shares of Netflix traded that day at this higher level. So why would they be committing all this money right here at the highest level if they didn't think that the stock could actually go higher? Now, I know some of the arguments, some of you are going to say, well, hold on, but look at the RSI. It is oversold. And you know, one interesting thing is we don't use RSI in terms of oversold or overbought levels. Okay, we use the RSI from the standpoint of the divergency, and actually this fast reversal right here could have been identified by observing this divergency. You see, when Netflix fell right here in November to these levels, 250s, RSI was right here at 30. When it fell much lower, right, it fell all the way to 230. RSI didn't shake. And it should have gone lower, but it didn't shake. So that was an indication that the bullish reversal was coming. And if you look at the S&P 500, you would see the same thing happening. So, but now that we're here, right, we should be getting a situation where, you know, we should be getting some higher volume on the sell side, because people should literally be coming in and taking profits, but we're not seeing that. And generally speaking, in situations like this, just because the RSI now is above 70 does not make it for a good case to short. Because a lot of times, if you study the history of Netflix, not many people realize that when Netflix gets above this 70 level on RSI, it could actually stay here for months. I mean, literally, there was a time frame in Netflix trading history where it has stayed above 70, 80 level for 4 months in a row. So for those of you that are trying to observe the RSI, I strongly suggest that you would consider the fact that it could maintain this high RSI for quite some time. And so just because it just recently got to what technically known as overbought, because it is over 70, that shouldn't be used just as a reason to be shorting the stock itself just by making this observation. Okay, now we could be using some observation like, look, clearly, well, there's the red candle right here. This is a bearish reversal type candle, right? But at the same time, surrounded by two candles that show clear support. And so after this gap up high, it looks like we're still getting people coming in and buying the stock right around these levels. Again, the question is, why would they be doing that on increased volume going into the earnings? I mean, can you imagine an institutional investor that bought, 50 million worth of Netflix stock right here at 260? Don't you think, when they're up so much in such a short amount of time, that would be locking in gains? And so this is what's crazy about this situation. And this is why we're saying that this time it's going to be exactly the opposite of what happened last time. So clearly, what do we mean by that? Well, last time it made sense to short the top. This time, I don't think it makes sense to short the top. I'll show you exactly what may be happening to Netflix shares. They may not just skyrocket automatically higher. Clearly a lot of things here are bullish, including the MACD indicator showing that, it's got a bullish crossover going on. The accumulation distribution is just within this short amount of time. It's not just fluff in this price action. It's actually backed up by accumulation distribution. Actually, the banks did accumulate a crazy amount of Netflix shares, and there's no signs that they want to get rid of them. So again, the main point out of this and out of these little errors right here and out of the volume and out of this, the most important thing to translate it in just to plain English, what would you do if you just invested billions of dollars and let's say after earnings, Netflix started falling from 351 and you were committing majority of your capital between the levels of 320 and 330, as we can see on this chart right here. Well, clearly, in the beginning, you wouldn't be committing this much capital if clearly you didn't already have some kind of information. So what that tells me is that if there could be some negatives in the earnings report, Netflix could drop. But what's going to happen, these institutional investors that will commit in a ton of capital right here, they will come in and they will buy more. That is the case why we don't believe shorting Netflix going into the earnings is a good idea. Buying calls right here may not be the best idea here. And if you've listened to some of our videos in favor of buying options, directional options going into the earnings report. As you can see, last time we waited after the stock popped to this level of 375, 380, and that's when we shorted it at this peak level right here. So what would be the strategy now? What are the probabilities of the outcomes that we're considering? Just one more chart. We're looking at the daily. This one is a weekly chart, and I like to look at multiple time frames because it really gives you more of a solid look. So if we look at the weekly chart, right, the RSI is actually not oversold here. It's at 58, which gives us a good idea that RSI could still be going higher here. So in other words, there's plenty of thing, even though this is a substantial run, RSI could still be moving higher. The volume is observed same, huge increase in volume on the weekly chart. We're just making a bullish crossover right here on the MACD, which tells us the stock could move substantially higher from here. And we're showing signs now of bullish accumulation right here on the accumulation distribution, still telling us that more people could come in and buy at the higher levels. Now, here's what we're observing. We believe there is a 65% probability investors will buy the dip in Netflix when it drops to 320, 330 range. And then they will actually move the stock to 350, 370 range in the next 72 hours following the earnings. Okay, now that's a 65% probability. Why? Because it is based on the fact where we were noticing some of the biggest accumulation time frames were happening in these levels right here, 320, 330. So if it drops here, I think the same institutional investors that were buying at these levels, they will come in and they will buy more to support the stock. And when the major selling is done, let's say from people that are trying to take profits that were buying it just a couple of weeks ago at 250 to 60, they will actually commit more capital and they will move the stock higher. Now, why do we think that we'll buy the dip in Netflix? Now, since this is the beginning of the earnings season, some of the most important things that we like to do is observe the general behavior in the stocks when they report earnings. And so the predominant characteristic of this earnings season so far, because we're literally like the early innings of this earnings season, this is what we're observing so far. Let me show you a few examples here. So JP Morgan after earnings, and I know in the last video we basically made a prediction that they will be buying the dips when the financials report earnings, which was kind of a contrarian view because if you listen to a bunch of people on CNBC or Bloomberg, they were talking about how financials were going to drop further. We said they were going to buy the dip. they did buy the dip. Check this out. JP Morgan, after the earnings, what happens? Drops initially from 102 all the way to 98. What happens within the next 72 hours? Trades all the way to 103, 102 range. So they bought the dip, and look how consistent this accumulation distribution is. Okay, Citi, 3 days after institutions bought the dip after the earnings. This is how it looks. I mean, you can't even see the dip, right? Well, that day, we actually placed the chart of Citigroup, right, because the reported earnings Monday. So it dipped to 55, and when it did, what did they do? They bought the dip, and look what happens after in the next 72 hours. Hits a level of almost 63. Now, the important observation of this, if you're trying to trade options and you're trying to figure out, okay, I want to play these earnings. How do you want to play them? Maybe just buying the earnings right ahead of the earnings report is not the best idea, because if most of the stocks are doing this, in other words, they're dropping, and you're actually bullish on the market right now, you want to wait till this drop happens in order to buy your calls, because they're going to be substantially lower, and so your cost will be lower, and that's ultimately how you make the money, right? You want to buy low, you want to sell high. So if you buy right now, the options are going to carry a significant premium, which is actually going to deflate your earnings, even if you get the direction right. Again, let's take a look at another example. Wells Fargo, after earnings, here it is, sells off to 47. Where's it later? At 49. So they bought the dip in Wells. Goldman Sachs, after earnings, you can actually barely see the dip, right? We were sending our VIP alert subscribers to buy these calls right here when Goldman Sachs was trading at 175 on Monday. And we had in our long-term alert subscribers, they've been buying up the 190 calls. At the time, they were 30 cents. They were going for as much as $8. Now we're actually locking in gains. Our target price was 195. So that's a huge return in 72 hours, guys, just making good observations about what is the predominant trend in the market actually is. Okay, so moving forward, you may be thinking, okay, well, you're just showing us how they're buying the dips in financials. Well, let me show you a couple other earnings reports that came in yesterday. So here's Alcoa. What do we have in Alcoa? So after the earnings report, what happens after hours last night? It dips to 27.51. Then they buy the heck out of it, driving it all the way to $30. And that's a steel company, right? CSX, transports. What are they doing with transports? Yesterday, after the earnings report, initial spike higher, then drops. What do they do today? At the 63 level, they start buying the dip in CSX. And look at the accumulation, right? It's supporting this price action, which is very important. It tells you that the move higher is very probable from here. Okay, now, here's a 25% probability outcome that right after the earnings, right, Netflix could just dip real fast and come back up super fast as well. So in other words, the difference between the first probability and this one is the fact that this is going to happen lightning fast, right? So at 4:02 p.m., you can see like just a fast move lower. It could be to the extent of $10, $15. I mean, it could actually touch the same level as in the first case probability, right, where it drops to the 330. But it's not going to stay there very long, right? It's just going to dip. They're going to buy the dip immediately, and they're going to move the shares much higher. Now, where could the shares actually pause? 370, 380 range, right? They may not get there immediately after the earnings report. So if we get a fast spike lower, followed by a fast spike higher, you know, the shares may ultimately stop at maybe a range of 360, and possibly tomorrow they can get them over to the 370, 380 range. And there's actually a 10% probability that Netflix will fall to a level of 287, 307 range. And yes, we do believe that at these levels, they will also be buying the dip. I hope this video was helpful, guys. If you are trying to learn more about charts, hopefully, you've already taken our divergences course, and so this information makes a lot of sense to you. And hopefully you've taken our 13 market moves course to make more sense out of the market, and especially if you're trading the short term like swing trading, or especially if you're day trading. Now, if you have any questions about any upcoming earnings, about how specifically we're trading Netflix, because again, the observation is not just to get the direction right. As you know, if you've been trading options for some time, when it comes to options, it's three things that are important. Number one is getting the direction right. Number two is getting the timing right. And number three is getting the magnitude of the move. Well, the timing is easy, right? When we're dealing with earnings report, the timing is easy. But there is a problem with timing. Even though, let's say, we know Netflix announces earnings tonight after hours, the issue is everybody else knows it, so therefore you have to pay higher premium for the options. Now, generally speaking, right, you want to follow the basic rule: buy low, sell high. Well, in such case scenario, it simply is impossible to buy low because why? Well, everybody knows the big move is going to come after hours, and everybody that actually selling you the option, they're going to be charging you a high price. So it really fails the basic definition of buy low, sell high. So how do you buy low in order to be selling high? If you're trying to get the answer to that question, all you can do is simply schedule a 20-minute free coaching session and get all your questions answered. And the way you do it, just simply click the link below this video. Simply click the link below this video. Take action now. Get all your questions answered. Take our courses. Learn more so you can be a better trader this year. I'll catch you guys on the next video. Oh, and by the way, the next video is going to be super, super important.